Hey everyone, welcome back to my channel. Today I want to continue my advanced price action series where I cover concepts like order blocks, fair value gaps, smart money manipulation, and high volume hedge pressure zones in great detail. If you haven't watched part 1 of the series on market structure breaks and order blocks, make sure you check that out first. Before we get started, I'll leave several referral codes for trading services I use in the description, including TradingView, Elite Trader Funding, and TradingView that will give us both discounts. Lastly, if you enjoyed this content, don't forget to like and subscribe to help me grow this channel. So with that being said, let's get into it. So I'm going to be talking about fair value gaps, which I've heard referred to as imbalances and also just regular gaps. And the first thing I want to talk about is what exactly is a fair value gap. And this is a screenshot I took of one. They've been all over the charts on SPY, ES, any of their holdings recently. And often I'll get into the reasons why that is, but this is a perfect example of a fair value gap where we have a lot of price action happening, a lot of auction happening in the market, and then all of a sudden we just see sellers completely take over and price just drops, forming these large candles where there's just really no buyers to be found anywhere in these. And then we even have another smaller fair value gap here. Now this is the 15-minute chart. These occur on all time frames, so we can see them on lower time frames, we can see them on higher time frames, middle time frames, and it's essentially an area where the auction process is not working as expected, meaning that the fair value for it. So essentially when we see price occurring here where we have buyers buying and then sellers selling and buyers buying, and price is working to find what would be considered the fair value, or it's in an area where there is fair value, all of a sudden that gets lost. We have a gap in the fair value, and one side just completely takes over and moves price in one direction in a very strong way. And I'm showing a selling example here, but this does also occur with buying. And so what causes fair value gaps? So oftentimes most often these are really caused by catalysts. So we're talking about macroeconomic events such as CPI, PPI, PCE, FOMC. Whenever we get a big data release and the market is either happy by the news or wasn't expecting bad news, and we'll just see sellers or buyers completely take over and price just completely plummet or run higher. They're also caused by earnings. Global events, we saw one when Russia invaded Ukraine, or we saw others when the banks were failing in China, and even over here back in 2008. Sometimes rumors can call them. Other breaking news, we've seen Reddit threads call them, most notably with GME and AMC. And then other times we'll just see market makers or smart money will just either do a whole bunch of selling or a whole bunch of buying all at once and cause these fair value gaps, and just one side is complete control. Usually they are smart about it. When they want to buy a position, they do it in stages. That way they don't cause a fair value gap, they don't cause a huge run up. And other times the same with selling, they'll do it in stages, they'll do it gradually, that way they don't cause these big gaps. And I want to point out that when we're looking at anything that really runs 24 hours a day or close to 24 hours a day, so futures are 23 hours a day, 6 days a week, but Forex and crypto can run 24 hours a day. Depending on what you're trading, they show up as fair value gaps, which we can see on the right side screenshot here. Now, if you're looking at the daily chart on equities, where the market is only open from 9:30 a.m. Eastern to 4 p.m. Eastern or 4:15 p.m. depending on the ticker you're trading, that's where we see them just as normal gaps. And we can see this is actually the same time frame in these two screenshots. The right is the ES futures, the left is SPY ETF, and we can see that the gaps in the chart occur because the daily chart time frame doesn't actually show the after hours trading, so those show up as gaps, but they work in the same way, and I just wanted to point that out. So you can call them gaps or fair value gaps. I guess it really depends on the type of instrument that you're trading. So the thing about these is that they usually get filled, and it's not right. Oftentimes it is right away, but it's not always right away. So this is a screenshot, and I'll also show this on the chart where we had this big rapid sell-off. This was, I can't remember if this was CPI or like Jackson Hole or some. It was a macroeconomic event, And then eventually when we held, and if you saw the last video where I talk about market structure breaks and order blocks, it's cut off in this screenshot, but we held, and then all of a sudden these imbalances start to fill. So the normal market auction process takes over. At this point, we sold off so hard that no one's willing to continue selling at this point. You're no longer getting a good deal by being a seller. Price drops so low that you get a good deal by being a buyer. So buyers essentially take over, and then we typically will cover this whole fair value gap all the way up to this wick right here where there wasn't a good auction process happening. We'll see this fill all the way up, and we can use this to our advantage. And just to show you what that looks like on the chart here, this is right here is the fair value gap I was referring to. Let me just zoom in on this area here so we can see sellers completely took over, and we just completely dump, and price gets all the way down to 36.40 on ES, which is very low, especially when we think about where we were at all-time highs. And so when we get down to this point, it no longer, if you're a seller, you're no longer getting a good price for selling this instrument. You're no longer, and at this point, it's more intriguing to be a buyer. You can start buying, and you always hear people say buy the dip. Well, this is like a true scenario where it actually makes sense to buy a dip. We don't want to be one of the first buyers. In my previous video, I talk about how here we start seeing market structure shift, and we start making higher highs. So, and then we start making a higher low, and this down here is called an order block. So make sure you check out that video if you haven't seen it. And essentially, if we buy in at the order block, once we get confirmation that we held through these wicks, then as we start moving higher, we can be pretty confident. Of course, nothing in the market is 100%, but we can be very confident that at the very least we'll make it up to this point in our price action. So we can hold. So say if we got in at one of these points and we had our stop below, we can essentially hold and capture all these points as we move higher, filling this fair value gap. Now in this case, we actually continued, which isn't always the case. Oftentimes we'll see the fair value gap fill, especially on lower time frames, and then we'll proceed with the move down. Now in this case, we kept going, which is something we would have no idea would happen, which is why it's important to take profits when we get to this point and just essentially leave runners if you want to keep trying to grab more of the move. And so getting back to the situation, so as I mentioned, this is a screenshot from part 1 where we saw this price action shift, and we saw an order block form, and we measured it using fixed range volume profile, and we start moving higher. So and I mentioned they do occur on every time frame. This is a screenshot of the 15-minute chart where we had a fair value gap at this point to the upside, and then it filled. But however, this filled very fast, and this essentially caused another fair value gap where all this price action, there was no auction process happening here. It was just sellers immediately took over, it dumped, now it's appealing to buyers again. And then we actually get a true market auction process here where this fair value gap that formed on these red candles actually fills all the way, and this off of this bull hammer candle would have been a fantastic entry. This would have been a great point to trade from on this 15-minute time frame. And the best fair value gaps always occur from these market structure breaks. So previously in this price action, we were in an uptrend, and then we drop, and this isn't a super clean fair value gap. There are some green candles in there, but there are areas that do need to get filled, which we see some of that getting filled properly, and then we get another huge sell-off. And then when market structure finally shifts back to the upside, we start filling this whole fair value gap. And it's safe to assume, again, I shouldn't say safe, I need to be careful in my terminology, but it's likely to assume that we would fill all the way to the top of this red line, and this is ES on the 2-hour time frame, just to demonstrate that these do occur on all time frames. We can use these on our charts depending on the time frames we like to trade, but it's always best to combine higher time frames with lower time frames. And that's one thing I want to talk about, is when we get these fair value gaps and we're actually playing these on lower time frames, there's something that I don't think I've ever really heard talked about on any other YouTube channel, and I actually took the liberty of marking it on the chart already. which it just is what I find really fascinating. So I'm going to pull this up, and this looks a little messy, but I'll show you what I'm looking at here if we zoom all the way in. So let me go to the 30-minute chart, and we'll go over to this area. I drew all the support and resistance lines. So what I did here is we have this consolidation point in the pre-market, and then we have this massive fair value gap form. And you can ignore these white lines for now. What I want to show is how essentially it took the fixed range volume profile, drew it over that area, and we can see we have all these high volume nodes, and then we have little gaps and high volume nodes, little gaps. Well, every area of high volume nodes forms what we call ledges, and we can see what I did is I simply drew these white lines on all these ledges, and there's a lot of them, and you don't necessarily have to do all of them. I'm just doing this for example purposes. If we are trading this fair value gap, and maybe you're a scalper and you want ways to scalp as this fair value gap gets covered, what we can do is we can mark all these ledges with white lines. Now, it took quite some time for this for us to come back up and start filling that fair value gap. You can see we had another one here, and then price kept dropping. Eventually, it got to a point where it was so low that it was very appealing to buyers to take back over. And that's when we get into the order block stuff that I talked about previously. We had a market structure break finally. We retested the order block, and we start moving higher. Here was the double fair value gap, basically. And then so as we start getting into that area, now we're back into these white lines, which is where that fair value gap that I drew that fixed range volume profile over. And if you're not familiar with fixed range volume profile, if you didn't watch the previous video, it's a tool that many platforms have that we can select here that lets us get deeper insight into the historical volume that took place in a certain area. And we can use these in consolidation zones or fair volume gaps, or wherever we want to measure volume, and where the points where smart money was injecting most of the volume, meaning where they were injecting selling volume or buying volume. And so if I drop to a lower time frame here, and you can see that it's not 100% perfect, but I just want to show how useful this would be to a scalper. So as we on this lower time frame, so on the 3-minute time frame, when we open and we started moving higher, we can see that we push through. Well, first of all, actually when it opens, let me just cover this real quick. So it opens, we drop, we try to move higher, we get to the first white line that was measured in that fair volume gap. We reject, we eventually break it, and then we hold the next white line. And we can see when we get to these areas where these white lines are really close together, this is good scalping territory where we could take longs. When we get wick confirmation, we could put limit orders, take longs, and just exit at the next one, because we don't actually know when it's going to break. We could see in this case, this middle line was only respected some of the time, and these are very choppy areas, so they can be difficult to play. So it might even be best to stay out, or if you have a long position on this break, essentially gradually slide your stop. But we can see how these act as support and resistances. And meanwhile, we're in this fair value gap. So the assumption is we're going to keep moving up through it. And we can use these lines as we continue moving up through it as ways to trail our stops or take profit targets, or, as I was mentioning before, scalping entries and exits. So if I go over to the next day in the open, we can see we open, we drop to one of those lines. We blow through it, we hold at one of these lines. It actually looks like we might hold here, but turns out to just be a pivot. And so you still need to be careful. You still need to use your normal techniques, for your normal scalping techniques. But I just find it really interesting that these areas where the high volume node ledges are injected end up becoming natural support and resistances in the future when we get to the areas where we start covering that fair volume gap. And so, unfortunately, as of today, today is September 12th, 2022, so I'm not sure if we can continue higher. It really depends on CPI data tomorrow. But the thing is, if we do start continuing higher, we can go back, review the ledges, and mark levels higher as we move through this fair volume gap, and use them as natural support and resistances well in advance. I mean, those were drawn almost a month in advance, and they still act as natural support and resistances. So it's a cool trick that you can use when you get those big moves. You can measure them with fixed range volume profile, and then get support and resistance levels to trade off of, depending on, and it's just a matter of combining that higher time frame knowledge, that higher time frame structure with lower time frame scalping, which is very important to being a successful trader. So I'm going to stop the video here, and for the next one I'm going to cover all types of market maker activity and how we can identify it and use it to take solid trades. If you found this helpful, or if you have any questions, leave a comment, leave a like, and I really appreciate you watching.